Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night. So we've been doing this, like I say, for 7 years. Oh, my goodness. You have nothing better to do on a Tuesday night than to be here with us. You know, we used to do speakers every week, and we'd have only 1 week of networking. And we've kind of flipped that. Now we're doing once or twice a month with a speaker that really can help you, that you can get into the room, kind of a small group, and be able to ask the questions. And you always need an attorney on your team. We talk about building our partnerships, and having an attorney on your team is critical. So tonight I'm very excited to talk and have Dugan Kelley in the house. And I'm sure if you are thinking about who to hire, maybe ask the question, how do I hire you? Why? What are some of the things that I should be asking about an attorney? How do I get to know you? What's most important that we should be asking? What questions should we be asking? So a couple things. Again, I'm a lender. I've been doing this I've been on the lending side for around 15 years. I've been in multifamily for about the same, and I've been in real estate transaction for 35 years. I know I look 29, but that's okay. Um, anyway, we look to be your resource for lending. Okay. So if you're looking at an asset and you're thinking, hey, how much is the lending? Please give me the opportunity to provide the debt. We're going to need a T12, a rent roll, your underwriting, all of those in Excel. And then if there's an OM, an offering memorandum that you have access to, send that along too. Okay, give me some details. How old is the asset? Where is it located? The address? How many units? How long do you want to hold this? Give me the details, because I then have to go and tell the story. It's all about the story to the lender. So we go on your behalf to get you the right solution for your deal. Okay, that should take us about 48 hours, and we can turn these for you. We'll give you feedback. Hey, the R&M is really high. Go find out why it is. Okay, we're going to start to ask the questions. You guys will come back to us, and then we'll give you a quote that you can figure out. Hey, should I be paying $6 million, or should I really be paying only $3 million for this deal? All right, let's kick this off. So Dugan Kelley, he's co-founded Kelley Clarke PC with the mission to deliver big firm expertise in a boutique and personalized experience to clients across the United States. Dugan chairs the firm's securities and real estate practice groups, assisting clients in all phases of multifamily, commercial, and residential acquisitions and sales. Dugan has been an attorney for over 24 years and has made a name for himself as one of the nation's foremost real estate attorneys, structuring deals more than $10 billion. Dugan is also a skilled advocate with over $150 million in settlements and verdicts for clients. He also created a registered broker-dealer with one of the country's first alternative trading systems in a secondary sales of assets. He also co-authored 2 best-selling books and is often sought after speaker on real estate, securities, market conditions, and creative problem solving. Dugan sits on several for-profit and nonprofit boards, and when he's not closing and negotiating deals for clients, Dugan spends much of his time with his wife of 25 years and 3 boys that keep him very, very busy. So I want to welcome Dugan back to Zoom at 8. How are you?
Thank you. Thank you.
It's so nice to have you back. And I mean, it has probably been a couple of years. And the fact that we've been able to survive. Many of us have survived. What did we start saying that in 23? We survived to 25. We're still alive.
Yeah.
How is it? It's going to be fixed in 26. It's going to be heaven in 27.
Yeah.
And
Yeah.
it's going to be great in 28. I don't
Yeah.
know but I think we'd love to hear from you what you're seeing in the marketplace. What
Okay.
are the challenges that we are facing, what we've already faced, and what give us some words of wisdom.
Okay. Thank you. Thank you, Julie, for having me. Love to be here. See a number of familiar faces and friends and colleagues. So it's always good to be here with you. Listen, I'm not going to hide it or sugarcoat it. It's been a rough couple of years. So if you're a real estate investor in the holy triumvirate of qualified non-recourse debt, mobile homes, self-storage, multifamily, it's been rough. It's been really rough. When the Fed started to raise rates in March of 2022, it turned into, I mean, the only thing I can think of is a shit show. It was really, really, really difficult for a lot of people. And because we do deals from acceptance of your LOI to the closing table, and then we do the litigation if God forbid you have to do. There are shadows of what we've experienced from 2022 to now of 2008. And I hate to say that, but there are shadows of it. It's not the same. So this is my third market cycle of being an attorney. The first time was wet out of law school with the tech bubble burst in the late 90s. And I saw that a lot of people were yes, losing money, but they were also making money in the down market. And then in 2008, I was a much more seasoned partner in a law firm, and we were doing a lot of commercial litigation. We were fighting against banks and lenders and insurance companies, hard money lenders that were on recourse loans, and we were doing workouts for people. And so that was
Mm.
very difficult. But I also saw massive opportunity. And now, from basically 2022, if you bought a deal, and I'm just going to make a generic statement because of we structure somewhere between $4 to $5 billion in deals each and every year in the various asset classes. So if you bought a deal between 2022 and 2023, 2020, that deal is likely in default, both monetary default and non-monetary default, particularly if you had a deal on a floating rate loan program. And if you're one of those people that's listening to that, don't feel ashamed. I wouldn't feel bad about that. There are thousands and thousands and thousands of loans out there. Every single loan that was on a floating rate debt platform, regardless of the lender, even Freddie and Fannie have people that are in default. And so the question is, what do we do now? Do we just tuck tail and go home and not do any more deals at all ever? The reality is, I'm seeing lots of distress, but I'm also seeing like what I saw in the late 90s and again in 2008. I'm seeing lots of opportunity. Take, for example, I have a client that bought over $160 million worth of commercial real estate in the last year with outflow of capital somewhere in the neighborhood of $4 to $5 million. That's unheard of. How can you buy $160 million worth of real property for $4 to $5 million? It can be done. So there's lots of opportunities. The problem is this is a lender-centric market. So if you're not cozying and cuddling up to Julie and getting to know the lenders and sourcing your deals from lenders, it's not a commercial real estate broker centric market. And I don't think we're going to get back to that market until 2027. That's just my own personal opinions. I think what you're going to see a lot of in 2026 is what we saw in 2025. And that is a lot of distress. If you're a current owner, operator, syndicator, or you're an investor in one of those deals, you've likely lost money. You will lose money probably unless your sponsors get very aggressive on how they modify or restructure those loans. And so what we are doing in a lot of the markets in last year and the year before that and this year is taking existing loan products, trying to match buyer from coming off the sidelines with willing seller, trying to rebank the deal with the existing lender, kick the loan terms out, waive some of the fees and the DSCR, the testing requirements that are imposed in these things, and survive and then lower the rate, right? This is a rate driven market. We all know this, right? this market moves on cheap debt. The problem is there's not a lot of cheap debt out there. So you have to entice the existing lenders to give you cheap debt. And how do you do that? You market to the ones that have loans that are not performing on their balance sheet, especially mid or smaller size bridge lenders. This is just my own personal opinion. If you approach them, they're going to have deals on their shit list, for lack of a better word. They're going to have deals that they need to trade. They need to take those deals that are non-performing and put them into a performing loan. And you probably have the ability, especially if you're somebody that's very aggressive, you have the ability to approach them and potentially pick up properties having the same lender that currently has a loan that's not performing, resell a credit enhanced borrower or KP team, and wrap that with a new loan and basically acquire assets. So that's what we're doing right now with a bunch of clients. We did around $1 billion of deals last year in this kind of product. And I think that in 2026, it's going to be a lot of the same, unfortunately, Julie. But it's a good thing and it's a bad thing. It's a bad thing from the standpoint of you're unprepared and this is your first market cycle. I want to encourage you, breathe, just breathe a little bit. You will survive this. There will be a lot of people that quit and they don't come back. I want to encourage everybody, if you're currently an investor, I'm currently an investor. I currently have lost money in a number of these deals, right? If you're currently a sponsor or an operator or a syndicator, if you're currently looking for potential deals, there's lots of opportunity for everyone involved, but you have to adjust your approach. This is not a CoStar call up your local Marcus and Millichap broker and look at what they have, because sellers are not getting realistic. So if you think that you're going to make money buying in at like a 2 cap, it's not going to happen. Cap rates right now, we've seen massive release of compression in a lot of markets. And so even if you're an astute finance person and all you're going to do is play rate arbitrage, you're going to buy, because now is the time to buy. I want to tell you, now is the time to gobble. You should gobble as much as you possibly can, because even if you don't see significant cap compression in your market or the traditional value add play or other types of rent enhancements on your net operating income, you can make a lot of money just on playing rate arbitrage. I'm in New York City. I spend a significant amount of my time each and every month in New York City on bended knee in front of lenders and investors, family offices, institutional money. This is not like 2008 where there was a liquidity crisis. There is plenty of capital available. You just need to be able to tap into it, and you need to be able to tap into it using a different pathway than what has historically worked. So for those of you that have been in this for a long time, you know that basically anyone, even a dodo, was making tons of money from 2010 to 2022, right? Anyone that could buy a deal was making a ton of money. That's not happening anymore. So you got to be very conservative in your underwriting. You got to understand the market. You got to think about where you're going to go on rates, and you got to think about alternative creative structures to be able for your acquisitions. Because if you're still relying upon like MLS and other things for your deal sourcing, that's out. You should be out there in Vegas with Julie. You should be meeting lenders, right? I was just in Miami at CREFC meeting other lenders. I'm potentially going to NBA in San Diego to meet other lenders, not for me, but for clients. Because if I can introduce clients to other lenders who have potential deals that they need to trade, that they haven't foreclosed on, that they've been doing this kind of extend and pretend, right? This extend and pretend, that's coming to an end. And lenders are getting pressure both from the Fed, the Treasury, the banking regulators. They got to get that shit from non-performing to performing. And it's super important that you know how the game is being played. not just in your living room, but you know how the game is being played at the biggest city, the central financial universe of the world. It's right here in New York City. So it's super important that you understand that even though you don't have to be an institutional investment bank to get deals in this market for the next year, you can get deals directly from lenders. They will force feed you as a potential buyer to potential sellers, almost like a making thing, like a speed dating sort of thing. So I want you to start to think about creative alternatives to the normal pathway for how you're sourcing and finding deals. All right, that was a lot of vomit
Well, I
from
want
the
to.
attorneys, but I want you to say, do you think does that resonate with you? Because you're in the rooms that I want to get into, Julie.
Yeah, it definitely resonates with me. I would say that if you're new, it can be more of a challenge to sit down with lenders. You have to have a track record. You have to have a sponsor that has this experience, right? Everybody. So you need to be thinking about who that might be. Rhea has experience. She's in the room. Vesey has experience. They're in the room. They can walk with you to these lenders and say, "Hey, what deals do you have?" I would say, Dugan, I'm curious, what size deals are you seeing that your clients are going after? Are you seeing 50 to 100 units? Are you seeing, okay, all those big deals are what's available? Because I really want to be realistic with
Right,
our group here. I know we send this out to a lot of other people and they have the potential, but for the people in the room that maybe, they can only take on 20 to 70 units or 80
right.
units. Are there opportunities with these lenders at that size?
Absolutely. So here's the thing. When I speak at conferences or masterminds around the country, and I see the kind of this, there was this old push by so-called gurus to be like, go big, go fast, right? I'm not a believer in that. I'm a believer in, if you start small so that you perfect what you're doing. And obviously there's outliers to everything. So if you stumble across a winning lottery ticket, by all means, pick it up, put it in your pocket, go cash it in. But in large part, if you're new to this, look at deals from a purchase price perspective of somewhere between on the 3 million to $7 million. Okay, you'll be able to get into a number of markets, and I think the down payment, the amount that you will have to raise, right? So if you're just getting started, and we were to think about like, what's this whole purpose? Well, syndication is merely the pooling of other people's money, right? Investors, you're the steward of those people's money to essentially aggregate that money and you back into a leverage, a loan, right? Just like if you were a homeowner and you're going to show up at the closing table and buy that, there's going to be a down payment that lender is going to expect for you to buy that house and give you that keys. It's no different in multifamily. It's no different than in mobile homes, self-storage, hospitality, mixed use. You're going to have some combination of debt where that Julie's going to be able to help you. So you always start with the debt. That means because you don't know what you're going to raise unless you know what you have to raise. And who's going to tell you that? Your mortgage broker is going to be able to tell you that and source that. But I say when you first start, from my personal opinion, if you're in that $3 to $7 million range, and remember, nobody does this alone.
Mm-hmm.
The people that you see on TV, the people that you see on radio, the people that you think are at the top of the hill from the syndication world, the rock stars of the world, they are not doing it by themselves. Okay, let me say that again. They are not doing it by themselves, nor should they. That means you shouldn't either. So if you think to yourself, I got to show up personally with $3 to $7 million, I'm not sure if my Rolodex is going to be able to tolerate that. That's not the way to think about it. You should start thinking about who are the people that are attending this. Getting to
Mm-hmm.
know them because they're potentially your partners. They're
Mm-hmm.
potentially your general partners that you could partner up to be able to leverage their network with your network. And I can tell you that you can raise a lot more money than you probably think that you can, right? Everybody goes into it probably with a fear-based mentality. But if you've been doing a few of these deals or you've seen other people do these deals, you can raise more than what you think. But nobody does it by themselves. So I think conservative, if you're just getting started, somewhere in that $3 to $7 million purchase price is probably where I would land. I would not be looking at 10 to 15 to $20 million. So however many units you can get with that, and it will largely be driven by the market or the submarket in which you're hunting. And the lenders, the stuff that I talked about before, they have all sorts of unit sizes and all sorts of loan
Mm,
sizes, right? They're not going to be looking at it from a purchase price perspective. In their mind, the purchase price is the promissory note price. It's the debt price. You got to find a way to allow lenders not to have to take a haircut on their debt. That's what I want you to start thinking about. That will crack the door open for you to have more and more conversations. And Julie's absolutely correct. Many of you don't have relationships with existing lenders. So
mhm,
even more so, you should be partnering or talking to the people inside of your circle that do have those relationships. And if you don't have somebody in your circle that has those relationships, you need to get somebody in your circle that has those
mhm.
relationships, because it's super important for you to be able to do that. So I'll say right now, the largest deal I'm doing right now is a $750 million data center in
Mm.
Beaumont, California, of all places. And the smallest deal is like a $25,000 condo that a brother and sister wanted to do out of Stamford, Connecticut. So like there's lots of opportunities, and there's from lenders as well as in the marketplace. It just matters on what you are most focused about, and then getting a plan together, getting your team together, and then implementing that plan.
Great. Excellent. So understand we have been in this issue, this having this situation for quite some time. Many people, as you mentioned, you included, and me, have been uh, investors in these deals. What can we be doing to make sure that we're um, doing like that the operator is doing everything that they possibly can be doing, communicating with us? Is there anything that you've seen over the last couple of years? Give us some examples of maybe some bad behavior,
Yeah.
and maybe where the limited partners got together and said, that guy, he's out, we're in,
Yeah.
and how that affects the deal and the investors.
Yeah. Remember, banks are not ignorant. These are not ignorant fools. The reason, well, these are some of the smartest people in the country, right? Lenders are some of the smartest people in the country. The reality is they know when your deal is in distress. They're forecasted when your deal is in distress. They're already putting into plans what to do about your deal if you do not do something about your deal. So if you're a limited partner in a deal and your sponsor is asleep at the switch, they're either not communicating to you, or they have their head in the sand, or they're just afraid. And it's
Mhm.
totally understandable. Listen, it is totally understandable that some deals will get foreclosed on. Maybe a lot of deals. It's not going to be like 2008, but there are deals that are getting foreclosed on. And if you don't want your deal to be one of those deals, you need to start communicating aggressively with your sponsor. That doesn't mean mean. I'm not saying be mean to them. I'm just saying pick up the phone, right? Email goes so only so far. You might have to fly there to take them out to lunch. You might have to get in their face. You might have to
Mm,
understand. You might have to share some amount of empathy or sympathy for what they are theoretically going with. Know that maybe they're paralyzed by fear. Maybe they don't know what the next step is. You might have to deploy kind of a SEAL Team 6 strategy into your own deal, whether that means that the LPs band together to essentially remove or substitute a control party inside of the deal. That is all on the table. The thing is, there's not a set pathway to getting a deal out of distress. There's lots of different ways in which deals can either fail in distress and get foreclosed on, and then you basically lose all your money. There's lots of hybrids approach where the deal trades at note value and you're taking back a hope note where you're going to participate in some of the upside by the next buyer that's going out on the next full cycle. And so I would say it's just really deal specific. But the worst thing you could do is not communicate. The worst thing you could do would be put your head in the sand and pretend like all things are just hunky dory, like everything was between 2010 and 2022, because it's not. And you got to adapt, and you have to be flexible, and you have to be talking to people, and you have to don't be pretending that everything is great, because it's not likely. And remember this, I'm telling you right now, my opinion, I've been doing this for 25 years. We sell several hundred, we structure several hundred deals each and every year. We structure over $4 to $5 billion of assets each and every year. We work with hundreds of lenders. I have literally hundreds of sponsor clients. Every single deal that closed in this time frame on this particular loan product, regardless of lender, is in default right now. And so pretending that it's not is to your peril. And that's why you need to be talking to your sponsors and helping them. And if if they're not in the right room and they don't have the right pathway or the solutions, then you could be the fire that starts that talk, that conversation, those solutions.
So just like you go and buy a stock at the stock market, you can't pick up the phone and call someone and say, I want to see some internal paperwork that shows me why my deal, of course, right now is not a good example of that because the stock market is doing well, but you don't get access to finding out why some things happen in the stock market. There are requirements from the SEC guidelines, but also on the operating agreement that says, hey, you don't get to see every conversation. You don't get to see everything behind the scenes that the general partner is doing. How do you rectify that? Because I think there are some GPs that overstep their bounds thinking, hey, this is an open book for me. How do you get right with that?
I mean, the sad reality is you could be a very seasoned entrepreneur, a very seasoned investor, and you could still lose money in this market. There was no guarantee. There was no promise from heaven when you invested into that deal that it would be a stone cold lead pipe lock, that you were going to get a certain return on a certain date or whatever. Everything that you saw inside of the private placement memorandum is what we would call forward-looking statements. It's an assumption. It's built upon assumptions. If those assumptions were faulty, meaning I don't know a single person that said, you know what, in March of 2022, Jerome Powell is going to decide in his fight to curb inflation, he's going to raise interest rates 11 times in this period of time, something that had never been done inside of the American economy, ever, as a country, ever. It had never been done that way. Okay. And then I don't know anybody that said, oh, yeah, and then let's sprinkle a little bit of insurance uncertainty where basically the insurance submarkets and markets are basically going to be decimated by competition, so that maybe you might have just one carrier in there and they're going to raise rates by like 300%. Oh, and by the way, there's this little bank called Goldman Sachs, and there's these Japanese banks out there, and they're basically the only banks that underwrite rate caps. Basically the insurance that's put in place, and that's going to go up by 400 to 500% during the same time frame. Listen, any one of these things, you don't need to have a total turd running your deal for you to lose money in it. Any one of these objective market factors in your deal, the deal that you invested into, would blow the business plan outside the water. right? So yes, there are definitely sponsors out there that overstepped the bounds, or GPs out there that maybe oversold their track record or didn't have enough experience, certainly didn't have experience to deal with this type of volatility in the capital markets, didn't know what to do when the market cycle started, still haven't done anything in connection with the deal to right size the deal or provide solutions. There's absolutely a litany, a trove of people like that. But there's also good, kind, people with high integrity, people with significant decades of track record of producing. And this market cycle has caused them to have some stinkers right now, or some deals with distress. So it's not it's not an either or scenario. It's really up to you to discern. Julie's absolutely right. You do have protections without even writing your operating agreement. I can tell you that just the boilerplate alone inside of most operating agreements, there are books and records, inspection rights, there's likely accounting rights. There's also what we call common law claims. These are claims that exist outside of your written contract that you could potentially enforce against bad sponsors or GPs that are doing bad things inside of your deal. So you're not without recourse from the standpoint of understanding what's going on in your deal. But Julie's right. Hindsight, it will only take you so far, right? Hindsight is 2020. And the reality is, litigation is almost never the solution. That's speaking from being a litigator for almost 30 years. It's almost never the solution. It's almost always the solution of last resort, not the one of first resort. Good business, if you find a deal that's in distress, being able to work through, figure out what rate will bear, what's the term that's going to do it, what does your occupancy need to be at to be able to be break even or positive cash flow. So I'm saying this, even if your deal is breaking even, that is still a good deal potentially in this market because rates are so high. So rates, I don't know a single economist out there right now, certainly not any of the ones that I'm talking to in the city, they're saying the rates are going up. No, rates are going down. That's why I'm saying, then this might seem opposed to one another. The diametrically opposed to one another to buy now. No, you want to buy now. When rates are high, you buy now. Because even if you cannot improve operations necessarily at your property, and if your property can sustain itself, either breaking even or positive cash flow right now at the high rates, when you refinance, that's going to look like a solid winner. That's what I'm talking about when we talk about rate arbitrage. You don't even need to necessarily improve net operating income. Sure, you will by cutting expenses, by doing certain things at the property that you're able to charge more for. That's going to increase net operating income. But what I'm saying is, in this environment, if you start underwriting just from an assumption of, I can't do anything, I'm not going to do anything necessarily, my effort's not going to necessarily increase net operating income at the property, is it still a buy? And the question is, at what rate, at what occupancy will it be cash flow positive, or it just won't be negative? It'll just be treading water, because if rates are going down, now my advice is complete garbage. If rates go up, you could just disregard everything I've said, because my assumptions and the counsel and advice that I'm telling clients, and the clients that are buying now, institutional family office clients, and just people getting into the business that are buying right now, are buying because they believe that rates are going to go down, irrespective of the asset, from the standpoint of whether they can increase net operating income at the property.
Oh, wow, that was a lot. There were some questions here. I think we should try and Bessie had a question about SEC. No, it was Angel. What are you hearing about taking loans in foreign currency to cut principal
What
in
am I
domestic
hearing?
loans?
Say that again.
What are you hearing about taking loans in foreign currency to cut principal in domestic loans?
I have some clients that are doing that, not a ton. I'll be honest with you, Angel. There's not a ton of people that are out there doing some of these alternative currency swaps that we're seeing play out. It's more certainly the rooms that we're in right now from the standpoint of triage. I would say most of the deals that are in distress, we're doing triage or trying to do wraps to a certain extent because we're trying to basically get existing financing, the existing lender to rebank the very same asset. But it is happening. It's just not happening at a wide scale.
Okay. Are there more than just the SEC again poor? Is there so there are more is there more than just the SEC again poor operators? Is that what you want to say, Angel?
Is there more you can do as opposed to just SEC files
Oh
against
yeah.
poor
Oh,
operators?
for sure. Yeah, I mean, there's litigation, not a ton of litigation, because remember, uh, uh,
Litigation is
people.
only good for the lawyer.
Well, that's true. That's true. Speaking as one, right? But didn't I tell everybody? I say this is the last resort is litigation, not the first one. But yes, litigation is generally too costly. It's too long. It produces uneven results. Many of the investments that investors have invested into have arbitration waivers in there, meaning you're going to arbitration, so there's no class action from an investor perspective. There's not really the ability to pool up in a class action. You could certainly everybody could band together and be all names in a lawsuit and sue the sponsor. But again, a lot of the sponsors don't have a well of assets. And having been on both sides, both on the defense side and on the plaintiff side, I could tell you trying to get to somebody's individual assets and pierce what we call the corporate veil through even a standard limited liability company is very, very difficult. It just doesn't
Mhm.
happen. I've only done it once in my career, and that was like on a child drowning case. It wasn't even a commercial real estate thing. It was a where a small child died at a resort. And so it was on camera and everything. And we got to the individual assets. So on commercial cases like this, where people are investing and there's lots of risks disclosed in there, it's really hard for investors to be able to get to the pockets of the individual sponsors on the other side. And so you're
Have we
you're mainly left with the whether the SEC finds anything in there, and a lot. And remember, the SEC is a complaint driven organization. They're not going out to find deals that have gone bad. And a lot of deals, I've sat with staff counsel in Washington, D.C., and in Dallas, Texas, and in Boston, Massachusetts, and other places. And they will say, just because people file complaints doesn't necessarily mean that we're going to find anything. And so there are a lot of investigations that don't go anywhere because, again, the objective market factors of the cycle have hammered a lot of these deals. And the debt products that came out from the existing lenders, couple that with what the Fed did, and you've got a toxic stew. It's not necessarily that somebody showed up with a ski mask and a pistol and took your money. It just didn't happen that way. It just is. It's just different.
Wow. Well, we've learned a lot. I mean, we've learned a lot from the cycle from 2008 to 2019. Economists, like you mentioned, they didn't see this happening whatsoever. I know that there were some SEC guidelines that were kind of going to start to change. Accredited investors, and then also having some co-GPs and how that kind of plays. Can you share with us how that has
Yeah.
changed?
I can tell you that if you're looking at this current administration, right? So we're in a new administration, right? The White House changed over. So every time the White House changes over, the White House picks of the 5 commissioners, the controlling party picks 3. The minority party picks 2. So you can kind of see how the game is played, even in Washington at the SEC level. And this particular administration is not the same as the last administration from a regulatory outlook. That means that they believe, even if there are missteps and there are abuses potentially, they don't outweigh the benefits of private capital being injected into the system, right? So I would say that the basic philosophy that we're going to see for this next administration from the Securities and Exchange Commission is invest. Even if money is lost, invest. There's not going to be, in my opinion, a tightening of accredited investor definition is going to go from $1 million to $10 million. That was floated, right? That's not going to happen. I think what more is likely to happen is some of the loosening that we saw in Trump's last administration before he lost the election. Biden came in. Some of the things that he had that in his administration before the Biden election happened was, I'll tell you about one that's going to earth shatter, was the conditional exemption on finders. So think about this. Right now, you cannot pay anybody a straight commission to get an investor. Somebody gives you an investor and you can pay a straight commission on that. They have a very limited historical finders exemption that exists in the current regs, but most of us counsel our clients away from doing that sort of thing. The Trump administration in October of 2020, so remember the dates, right? In 2020, he had proposed, there was a press release that came out. You can even get this. It came out in October from the Securities and Exchange Commission. And it basically said, hey, we're going to set up a system by which finders, AKA rich people that know other rich people, can introduce those rich people to syndicators and get paid a commission. We're going to set up a regulatory framework by which that can actually be legal and compliant. That is not legal and compliant today, but it was proposed with guardrails under Trump's last administration. So if you wanted something, if you were hoping that, oh my God, that the SEC is gonna wrestle all these bad people to the ground, they're certainly going to do that. There's been a lot of enforcement going on, and it's been a good thing. But there is a natural tension. Remember, there are pillars to the SEC. One is formation of capital formation. A lot of people forget that. They just think about investor protectionism. So if you think, what is this? If this administration has to pick one or the other, are they going to pick investor protectionism or are they going to pick capital formation? They're picking capital formation. They're showing you signs by the people that they pick to run these organizations that they want more capital to flowing in. The loosening up and the regulation for around Bitcoin. I think you're going to see crypto, more and more of that type of stuff filter in. You're going to see more trading on the secondary asset thing. So you're going to see lots of those types of things loosen up, I think, over the next couple of years. I don't think you're going to see a tightened regulatory framework. If the next administration flips to the opposite party and they come back in, you're gonna have a whole new regulatory outlook to look at. But most of us, we're trying to read the tea leaves. We're just reading the tea leaves by who are they picking, where do they come from, what's their philosophy, and what do they talk about. So if you want to know what the SEC is thinking, you can go to their website. They push out minutes of their board meetings and their commission meetings, and people, when they go on the stump and they talk out at colleges, they tell you what they want to do from a regulatory outlook. And that's your best indicator of what we're seeing and what we're going to see in the next couple of years.
Excellent. If we were to look back in 2019, maybe even earlier than that, we had a lot of education programs. They put out a lot of people that were doing deals. They were selling, buying, holding on, selling it to their next group of education students and so forth.
Yes.
I think there's a big piece that had been missing. And the big piece was, how do you protect yourself? How do you work with a an attorney? What are the things that are most important to be educating these people on? I think the education programs are going to, they're not going to be as popular because of some of the regulations that they're being held to. So for the new people in the room and the people that are not part of an education program, what is one or two things that you would want them to know from a legal standpoint? How do they protect themselves as either as a general partner or as a limited partner?
It's a great question. I would tell you that the law already has strong safeguards to protect you. So remember this, the rule of thumb, regardless of what state you live in, is that the debts and obligations of an entity that you either control, or you might be the managing member or the manager of, you are not responsible regardless of what decisions you make. Now, I'm not talking about lying, cheating, stealing. If you lie, cheat, and steal, God help you. Somebody should come after you and hold you accountable. But if you're making decisions, business decisions within the normal course and scope of operating, and you made negligent decisions, hear me again, you made a negligent decision. You made a decision that was an error. And in hindsight, you would have made a different decision. You are protected by the laws, generally speaking, in that state from personal liability. Okay, so understand that. But I think where a lot of these programs potentially missed opportunities was there was so much opportunity that the follow through was just not there. Meaning when we talk about why some of these deals failed, it's not necessarily because there was bad underwriting. There certainly was bad underwriting. I'm not gonna sugarcoat it. But it was the asset management component of a lot of programs that was not stellar. So if I could tell you, if you're just starting your journey, welcome. This is an amazing industry to be. I love it, even though lots of people have made lots of money and lots of people have lost lots of money, and that will continue to happen for as long as we're here. But asset management is where I would really put both your money from a teaching perspective as well as your time and your attention. And so when you're underwriting things, it's not just getting the deal, it's operating that deal. You got to operate the deal, and you have to challenge some of the assumptions because, like we said, this is the third market cycle. So some of us that have been doing this for a long time, we know we can breathe. You can breathe. You're going to be fine. You're going to be fine. Everybody's going to be fine. But you got to get through the cycle. And if this is your first cycle, you might think that the sky is falling. And in part, that's because the ability to operate and to do that has been lost a little bit. So I would say your team is super important. Spend money and attention on educational programs or masterminds or groups or coaches that will teach you that follow through aspect, because getting the deal is great. But if you can't operate the deal to a successful exit, that's going to hamper your track record. Even if you're going to continue to be in the business, it's going to really hurt yourself.
Yeah. I'm Dugan, I am with you. I feel like I'm addicted to this industry. I love it so much. Sometimes I just think, gosh, why is it so hard? How can we make it easier? But you do want to protect yourself. You want to do all your due diligence, and really so important on so many levels to make sure you're investing in the right team, especially during this time. Let's open it up to anybody in the room. Again, this is an opportunity to ask the professional. You get an opportunity to be in the room, and you don't have to make any phone calls. Can't be awkward on the phone call. Come here. So if anybody has a question before we let Dugan go, it's time for him to go to bed.
Right.
Let's open it up. Vesey.
I have a quick question, and thanks for sharing, Dugan. I imagine clients are bringing you in to the table and they are negotiating extensions. So curious to see what kind of terms you're seeing in multifamily in the current environment that lenders are requiring for borrowers who are already willing and able to accommodate.
Yeah, that's a great question. I wish that I had like a 10 point thing. It kind of depends on the lender, right? So I've seen a lot. It almost always starts with a pre-negotiation agreement. So they basically want to be able to have free flow communication between them. Um, and I try to encourage people, if you can do it without a lawyer, that's great. Or if we're in the background, because once lawyers get in the room, the fear tightens up a little bit, and then it gets a little bit more adversarial. So I try as best we can to coach the clients that to try to do it without the lawyers. But a lot of them are looking for capital, fresh capital into the deal. We try to hold back that. We're using the carrot of potentially fresh capital with the hammer of we need to extend out the loan. We need to waive DSCR testing requirements. We also need to waive potentially some other fees that are being charged. And most importantly, we're trying to negotiate rate down. And even if that means that the existing sponsorship team is out and there's a new sponsorship team in, that sometimes is the best leverage, because these are human beings. They cannot sell often the very same faces to credit that just failed on their business plan. So if you're able to present them even with LPs or a new potential buyer, even though it's not really a buyer, it's a new buyer, it's a new face. That is sometimes the best anchor for you to be able to get inside and get a deal that can actually work in there. So if you start thinking about, hey, I want to go to the lender and I want to tell them the deal sucks right now, the deal has failed, and here's what the deal will work. That is much better coming from somebody that is not already a KP, a guarantor, or a manager or managing member on the very same deal. It's just human beings, right? They're not going to be able to go and say, you know what, to their own credit, you're right. It wasn't their fault. It was our fault. Our underwriting also sucked, and we sucked on operational oversight. So, let's give them a break and tear this up and give them a brand new loan. That doesn't happen. So we have to know how the game is played now. You have to find the ability for the lender to save face. You have to understand what their pressure points are, what they want. Most of them want fresh capital. What you want is you want a longer runway to see cap compression so that your business plans can work out. So you have to find that natural tension that exists between that in order to make it work.
Right. Are you seeing that they're coming down to 4 and 5% on those deals to bring in a new buyer, or are they more
Sixes.
up into the
Sixes?
Yep.
They're in the sixes still. Some are in the fives, but it's like those are the ones that they're about ready to foreclose on, and you're like swooping in so that they don't have to take it and put it on their REO schedule. So
okay. All right. Anyone have one last question? Burning question. Alex, you always have a question. You're sitting back.
I do, but I don't want to spoil this. So it was great, Dugan. It was great presentation.
Ask it.
No, come on.
Yeah.
It's too dark. So I'm gonna.
Too dark? Come on.
anybody that wants to talk
Too
dark
dark.
question, you can call me up. We'll talk dark offline.
Exactly. So I appreciate that, but
Okay.
not today. Thank you.
All right. No worries. Well, Dugan, very, very helpful. I think
Much love to all of you,
Dugan.
especially to you, Julie, one of my
Thank
favorite people. Super, super cool. If you don't know this chick, get to know her. All right.
Dugan, thank you so much. I'll look forward to seeing you next week. And everybody,
Yes.
Dugan, have a good night.